Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for October 5th, 2021. I'm Ken Adamo, Chief of Analytics at DAT, joined as always by Dean Croak, who's our Principal Industry Analyst, Ned Damon, Principal Data Scientist, and a very special guest this week. We have Andrew Silver, CEO of Molo Solutions. Welcome, guys.
Howdy.
Hey, good morning.
So thanks for coming on, Andrew. We really appreciate it. You've been all over the news the past week, and we'll get to that in a little bit. But do you mind giving the viewers real quick a rundown of what you've been up to and a bit about what Molo, what role Molo plays in the brokerage industry?
Yeah, sure, absolutely. So I'm Andrew Silver. My background is I kind of grew up in the industry. My family having been involved in freight dating back to the 80s. Grew up at Coyote, which is still, one of the more revered logistics companies in the industry, and learned really everything I knew there. And wanted to go out and build something for myself with friends, and that's what we've been doing for the last 4 years. We're primarily, and I shouldn't even say primarily, we're almost exclusively a truckload freight broker. Really just focused on trying to do the best we can to give our people the best experience in the industry, as well as our drivers and shippers. We have a very simple philosophy about how we go about doing things, and we've been very focused on that for 4 years. And we're just incredibly fortunate that a company as I guess revered as ArcBest was interested in partnering with us, and we've got a long future ahead with them.
Yeah, I'm really excited to talk about that later. I heard a rumor that you went to Michigan. Is that right?
I did. I did go to the University of Michigan, but I was not the best student, so I don't pride myself on that so much. I was working though. I was a freight broker still.
Nice. Well, we'll let it slide. So the freight brokerage sort of outweighs the team up north, as a diehard Ohio State fan. So okay, we have much like last week's show, we're gonna breeze through a bit of the market update stuff, but as always, you can catch that on our website. Dean's full written report, all the charts and graphs will be there because we have a really great conversation we're going to have with Andrew. We're going to bring him back in a few minutes. So with that, I'm going to dive right into our key points of the week to get us moving here. So disruptions galore. Dry van and reefer rates up a penny and rather flat. Not a ton of action there. LA to Las Vegas rates are breaking $6 a mile. Again, these off-port lanes are just wild. We're seeing end-of-month stuff from September building, as well as peak shipping just combining for this snowball of volume. And then I think the big freight-adjacent news story is the oil spill in Southern California. Multiple unconfirmed reports, or at least speculation, that it could be or could have been a ship's anchor dragging along the bottom that caused the spill. I think more will come out about that. But there is a lot of talk around what this means for port traffic, whether vessels are definitely going to have to be cleaned before they leave port coming back out. That's been stated. Question becomes, are they going to divert heading in? The ecological disaster not to be understated. So with that, I'll turn it over to Dean to run us through the market update. Dean?
Yeah, thanks, Ken. Let's start off with the load board activity in the dry van sector. As Ken mentioned, activity was up last week. Pretty traditional end-of-month dock clearing shipper behavior last week. Load post volumes were up about 10% week over week. Equipment posts were down last week about 5%, so they had the combined effect of shifting the load-to-truck ratio up a few points, 6.17 to 7.10. In the refrigerated sector, similar trend. Volumes are up last week about 7%. Equipment posts were down about 4%, so the movement in the load-to-truck ratio was up from 12.95 to 14.35. In the flatbed sector, it was about the fourth week in a row, I think, based on the data where load-to-truck ratio has been increasing, another 7% week-over-week increase in load post volume for flatbed. The load-to-truck ratio moved up again, 50.38 to 56.44. So taking a look at our three equipment types in dry van, Ken mentioned port congestion, about 62 vessels at anchor as of last report on Friday. It's actually very close to 500,000 TEU are sitting waiting to unload, so there's a lot of congestion there. Vessel wait times out to 10.1 days. That's up a whole day since this time last week. So lots of volume building up there. We track that fairly closely. Capacity is fairly tight out of Los Angeles as it is. Spot rates were up a cent a mile last week to 326, 2% week-over-week higher volumes. On the dominant intermodal lanes, Chicago out of Los Angeles, spot rates were up 5% last week. Loads moved increased 19% last week as shippers took advantage of the what truckload capacity there was to move freight. Loads on that particular lane, Chicago out of Los Angeles, are up 72% year over year. In the refrigerated sector, lots of fall volume making in the markets, especially in the Pacific Northwest in Pendleton. That includes the Yakima Valley. Spot rates have been up for the last 4 weeks in a row. Load post volumes out of that market were up 13% last week and up 51% month over month. Spot rates were up 6%, 6 cents a mile last week to $3.12. A lot of volume was going to Milwaukee. It's at close to 2,000 miles. Reefer rates are up to $3.06 per mile, excluding fuel. That's up 70 cents a mile higher than the same time last year. Having a look at the flatbed market, we're having a closer look this week on our long-form market update report. We're having a look at Gary, Indiana. According to the American Institute of Steel, domestic raw steel production is up about 22% year over year. That translates to about 14,000 additional truckloads of flatbed steel coming out of the various steel markets. Most of the volume comes out of Indiana. It accounts for about 27% of the nation's steel production. It's about double the volume of the next leading state in Ohio. Spot rates, flatbed volumes were up 20% last week. Spot rates are up 17 cents a mile out of Gary, Indiana to $3.36, excluding fuel. And wrapping up with our year-over-year look at, and I've just lost my screen here. Having a look at our year-over-year look at dry van spot rates. Higher end-of-month volume pushed dry van spot rates up last week, only moved up a penny per mile to a national average of $2.53, excluding fuel. Compared to the same week last year, dry van rates last week are 12% or 30 cents a mile higher than the same week. Having a look at our refrigerated sector, we can see that there was a brief pause the week prior, but spot rates again increased last week. So they're up to about $2.86 excluding fuel. That's 49 cents a mile higher than this time last year. And wrapping up with our flatbed rate view, flatbed were flat last week, $2.66 a mile, no change there. Still 16% or 43 cents a mile higher than the same week last year. So that's it for this week's market update. As always, if you want to find out more about what's happening in freight, go to our website, go to dat.com/market update and download our weekly report. That's it for my update. Over to you, Ned, for the short-term forecast.
Good morning, everybody. Before we go into too much detail, I have two little news items. First, we would still appreciate listener questions. So if you can get those listener questions in, we'd love to take them after we're done with our IQ question of the week. Really looking forward to hear from you. Second is that although I don't have it this week, in the very near future, we've heard you and we're getting together a LTL national pricing trends analytics element so that we can talk to that, because I know that you guys have been really interested in seeing what's going on in the LTL market. So we don't have it this week, but we're trying to get it to you as quick as we can and still give you the data quality that we expect. So stay tuned, I suppose. Now moving into the forecast, we're going to start off with our national dry van forecast. In blue, you can see the market rates observed by DAT, and then off to the right, you can see the forecast. So in red, we have our short-term forecast, which is expecting rates to stay more or less steady through the early part of November, maybe up a penny or two. Ratecast is expecting rates to start falling once we get into the middle part of October, although there is a broad agreement between all the models about what's going to happen between now and the next couple of weeks. And then the two blended forecasts in gold and silver are straddling the middle there, expecting rates to go down by maybe a couple of pennies, but more or less hold tight. Moving on next to reefers, we can see once again in blue the market rates observed by DAT. In red, the short-term forecast is expecting rates to have a little bit of bumpiness due to day of week, week and month effects, but overall kind of maintain levels. Ratecast is expecting a little bit of a drop, then a correction back to this about the same level that it's currently at, and the blended forecasts are leaning a little bit more towards ratecast. Again, the short term is in red, ratecast is in green, and the blended forecast, which are mixtures of those two forecasts in different amounts and in different ways, are in gold and silver. Finally, moving on to flatbed, here we have the biggest model disagreement. Once more in blue, we have the market rates observed by DAT. And then you can see that there's model disagreement basically kicking in at the start of next week, with short term expecting rates to stay steady to up heading up a couple of cents, whereas Ratecast is once again expecting rates to hold for about a week or so and then start dropping. Here it looks by about 5 cents in the middle part of October before beginning a course correction back up. Here, the blended forecast in gold and silver are leaning a little bit more towards the short-term model, expecting rates to drop by a couple of pennies, but more or less hold fast. And that is it for the forecast. Over to you, Ken, for our IQ question of the week.
Thank you, Ned. So our IQ question of the week, I'm going to deviate a bit from the script because I want to level set for everyone. For those not familiar, for those not reading the news, it was announced that ArcBest will be acquiring Molo Solutions. And we thought it would be a great idea to have Andrew on, and he graciously agreed to talk about it. So my question for you, Andrew, is why did this make sense for ArcBest and Molo compare, to go with a strategic partner versus some of the other routes you could have taken, which was, raise some cash, go the private equity route. It looks like I read your post on LinkedIn. I recommend everyone check that out. It was a great write-up, but I think to hear from you why this made sense for Molo.
Sure. So there are a number of reasons, and I could probably talk for 2 hours about why we did what we did. I've spent the last 3 months doing nothing but thinking about if this was the right move, to the point where I lost 15 pounds and probably some hair on the top of my head. Thank God you can't see that. So a couple things here. First and foremost, it's very expensive to grow a business the way we have the last 4 years. We are very enterprise heavy, right? So, we did $130 million in 2019. We did $275 million of revenue last year. We'll probably do about $625 this year. And we're doing that with about 500 customers, a lot of which are in that Fortune 500. As you're a new broker in a sea of 24,000 brokers, and I'm trying to get an opportunity to haul for Anheuser-Busch and Molson Coors, these larger enterprise level shippers, I don't have much leverage in our contract negotiations. In fact, I probably have zero, just about. So a lot of the payment terms we have with some of our larger shippers are much longer than we'd like them to be, right? So our average, we're getting paid in about 60, 65 days from a lot of our customers because of that. And we got to pay our carriers fast, right? I mean, we're trying to be at least at 30 days. Would like to be even better. But when you're growing at the rate we are, we're doing $2.75 million of revenue a day, and you're managing that float 35 days, you're borrowing a lot of money. And in an industry where margins are low enough as is, to be paying the interest on the borrowing, it just eats into the little margin you already have. So for us, it was about 6 months ago where we actually made the decision, hey, we're going to go do private equity. I'm obviously, I'm not obviously, but I'm good friends with Matt Pyatt, CEO of Arrive Logistics. They are our friendly competitor. I like to poke at them as much as I can, but we're close. And when they announced their deal, our businesses are similar. They're more small, mid-size. We're heavier in the enterprise, but the growth patterns are similar. They're 2 years ahead of us. They started 2 years earlier. We've grown a little bit faster. But my point is, when they announced their deal that they'd raised $300 million, I called them and I said, hey, give me your banker. I'm going to use the same guy. I want the same kind of deal. It looked like a great comp for us. And we started that process. And we started building a sim. And the plan was private equity in all likelihood. I remember telling my people in one of our company-wide meetings, I said, I think there's a 95% chance we go private equity. There's a small chance we get introduced to a strategic partner that makes sense. That's when I met Danny Lowe. And he came in, we had lunch, we had dinner, we sat here for hours and talked about our businesses. I've talked to him more than I've talked to any human on the planet in the last 3 months. And really, I've gotten to know him. And I've gotten to trust him. I care, and my people care more about this business than maybe anything we've ever been a part of. And it's really important that the future of this business is as bright as the past. And I knew no matter what, I was probably getting a new boss, right? If it was private equity, it was going to be somebody who I'm talking to who's giving us a bunch of capital, and then they're going to want to run the business somewhat the way they want to. Or it could have been someone like Danny. I found over the last 3 months someone who I trust. And that is more important really than anything else. As we think about the future of these companies together and what we're trying to build, we have extremely ambitious goals. We've always had ambitious goals, and we've never been afraid to be bold about stating them. I want to catch Robinson. I mean, it's as simple as that, right? They're the 10 plus 13 billion, whatever their revenue is. I haven't had to really look at it because we're pretty far away today. They're a good company, but I think we can catch them. I think that we do things the right way. And if we continue to focus on that, on the experience we create for our employees, trusting them to create the same great experience for our drivers and shippers, I don't see any reason why we'd slow down. All of the conversations we have with our customers are them saying, we love what you've done for us. We want to grow with you. And we're seeing that in bids. We're seeing that in the spot market. We're seeing it everywhere. So when I think about why we did it, there's a big reason here I got to emphasize, other than the trust and the confidence in what Danny is going to allow us to do. I think the single hardest thing to do in freight brokerage is get a meeting with a customer. It's not even closing once you get the meeting. It's just getting the meeting, right? There's 24,000, I think is the number people use, 24,000 brokers out there. Every transportation manager in the country gets 100 emails a day asking for their time. That's been the hardest thing for us. That's been the one part of our business we haven't scaled well enough to date. For a $625 million business, it's crazy in terms of revenue. It's crazy. We only have 25 salespeople who are actively talking to new shippers trying to solicit business. I can't grow at the rate we want to grow and scale at the rate we want to scale with that type of group. We've wanted to scale. We just haven't been able to make the right moves. ArcBest has 500 salespeople. They have 30,000 existing customers. Those 30,000 existing customers love what they do with the ArcBest team, whether it's through the ABF Freight or it's through the Panther Expedite or it's through the drop trailer owner op program they have out in Reno, Nevada. My point is, we don't have to worry about the solicitation process as heavily as we do, because they've got all these customers. They just got to introduce us to them. And if they can get the meetings set up, our team, I have more confidence in our execution team, the platform we've built, the group of people and the way they execute. I have more confidence in that than I've ever had in anything in my life. And basically what we're saying is we're going all in on that. We're going to trust the ArcBest sales force and our continuing salespeople to do their jobs and get us those opportunities. But I know for a fact, if our people get the opportunity to service these customers, we will do well, we will grow with them, we will be profitable, and we can be sustainably profitable over time and continue to grow at the rate we've been growing.
It's hard to beat that footprint, right? I mean, a lot of these customers are going to have ABF trucks backing up to their docks every day, right, on the LTL side.
Yep.
And that's that familiarity and that exposure that they have to the brand as a whole that can sort of full back you in there, if you will.
Yeah. I would add too, I don't know anything about LTL. I don't know anything about intermodal. I know about truckload brokerage. And a lot of our team that we've hired also knows a lot about truckload brokerage. I've always been asked in our training classes, like, would you guys ever look at LTL, intermodal? And I'm like, yeah, but we don't know anything about it. And we've been growing at this ridiculous rate. We couldn't grow any faster if we wanted to. Part of my thought is stick to what you're good at, right? Yeah. Get really, really good at that and stay focused and stay in your lane. Well, this deal is a perfect opportunity for us to do that, right? And let our salespeople go learn about the other services and be able to sell those services, and us be able to create one solution for customers, one logistics solution, not just a brokerage. But we get to focus on what we're good at, and that's what we love. I love what we do. I would consider people like, you're selling out, you're leaving. I'm 31 years old. Where am I going to go? I love what I do. The people I get to do it with, I owe it to them to sit here and continue to grind with them the way that they've grinded with me for the last 4 years.
Well, that's really like it's an interesting, I like that you brought that up, right? Because I think if you look at other big exits, right, where Coyote going to UPS, other examples we could point to, it was at a lot different point in their growth trajectory, right? This is an interesting point in Molo's growth trajectory to take on a strategic partner. And hearing you talk, it sounds like that's almost entirely focused on fueling your growth, right? You're not entering into a harvest mode. You want to continue fueling that growth, is what I'm hearing.
I mean, the idea that this is an exit is ridiculous. This is not an exit. This is an entrance to me. This is, if anything, I see this as Molo investing in the future of our collective companies. Because yes, we're turning over the keys. We're turning over the 100% ownership to them, but we're doing it because we trust they're going to allow us to keep doing what we're doing because we do it well. To me, that's all it is. We're so bought into what we're doing, and we love what we do. The fulfillment I get from what I've been able to do with these people over the last 4 years, there's nothing else I'd rather be doing, and I see so much potential. This is not a deal that was done based on what we have done. It's a deal that was based on what we will do, and it's collective, and we're all bought in. The culture thing is interesting, and I think there's concern there from everyone. You'd be crazy if you're not concerned. Change is scary in general. We've got this phenomenal culture we've built. What I've found in the last weeks, months, and even the last few days of actually going to meet more of these ArcBest folks, as much as the Molo people love Molo, these ArcBest folks really love ArcBest. And a lot of the people that work there have worked there for 25 plus years. And you don't see that very often. You only get that if you have an organization that takes care of their people. It will be the most challenging thing we ever do to make this work in terms of an integration, but it'll also, again, probably be the most fulfilling. I like the idea that others have failed trying to do what we're about to do. That's what fuels me and makes me want to do it even better.
So that's another good point. There's the Molo way of doing things that's come up a lot. I think in a short time, you've made that a bit of a brand. And I come from another customer-obsessed company, right, in FedEx, with the, make every customer experience outstanding is something you hear almost every day. How do you, what gets you excited about bringing that Molo way of doing things into the ArcBest portfolio?
I think it's just staying consistent, most importantly right now. I know it would be hard for me to comment on that, specifically on the ArcBest side, because I don't know enough about them. I know that Judy and Danny and their team are they use the term obsessed with the customer experience, and that gets me excited. For us, we just simplify it so much. I mean, it's so much from my team at the highest level saying we got to create the best experience for our employees, and then asking them very simply to focus on creating a good experience for the drivers and the shippers. That's the only way we're different. And they're not monumental differences when I look at us versus our competitors. It's in the inches, right? It's in the conversation you have with the driver, and are you pleasant with them? Are you respectful? Do you appreciate the work they do for you? Do you go out of their way to make them feel like you work for them and not vice versa? And you don't see that in the data and the numbers. It's a feeling to me, and it's something that can be infectious. No, it is infectious. I've always thought about culture from the perspective of take 10 people, put them in a row and let them do their jobs. What happens when I put the 11th person right in the middle? Whether they have good intentions or bad intentions, over time, they're going to behave like the people around them. And my goal is to make sure that my 10 people in a line are doing everything the way we ask them, which simply, again, is about how they treat each other and the way they engage one another in our workplace, and then how they take care of the drivers and shippers that we partner with.
That's awesome. Yeah, I mean, that culture becomes infectious, right? When everyone's sort of trying to get the customer solutions and kind of focused on, especially in these environments. I can remember back in 2018, that early summer of 2018, where things were, and I'm sure you experienced it, Andrew, where things were just nuts, right? You couldn't move the freight if you wanted to. I mean, you people locking caps on their pickup truck to go haul freight in 2018, and it was just exhausting. You left the day like a wrung out wash rag, but it was just so rewarding because all that freight just meant that those customers' businesses were, these were lying down situations in almost every single case. So it's a super rewarding experience to see deliver and, to make your carrier successful. That's the interesting part about a brokerage that most people don't realize, right? You have customers on both sides. You have the carriers and your...
Not just both sides. There's three sides. This is what people don't realize. My employees are my most important customer. Far and away. This talent war going on. Every one of my employees got 15 LinkedIn messages last week of people saying, hey, that place is going to suck now because they got bought. Come work for us. And I'll sit here and fight that all day because I've told our people knew about this deal 3 months ago.
Right.
How many companies do you think would be that transparent? And granted, obviously, they didn't know it was ArcBest. I couldn't share that information. But we've shared everything. We've been overtly transparent with our people from day one. It's an important part of who we are and how we communicate because they know why we do what we do. They're never surprised by what's going on because they always know what's going on. And I wouldn't have done this deal if I didn't think they would have been behind me in the first place. We asked them straight up. We said, hey, this is what's going on. This is why we think this is the right move. Again, not sharing who the company is. We looked at private equity. But this strategic deal makes so much more sense because of the opportunity, and opportunity drives buy-in. People 21, 22 years old, you want opportunity. You want a chance to prove yourself, to learn, to be challenged. And that's what growth creates. Growth automatically creates opportunity because you need to promote more people. You need to give more people opportunities to take on new challenges. Yeah. So we said, hey, this is what we want to do, and this is why I'm scared. I'm scared a little bit of what could happen when I turn over the keys because it's not up to me. They could change what we do. But I don't think they will because I think they're bought into how we're doing it. That's one of the things. People get bought into what we do. We don't have a problem with that. So I think that these people will get bought in just like our people have over the last 4 years. But when I asked them, I said, hey, can you guys tell me, I need to know how you feel about this if we were to go this route. We got hundreds of messages from our people saying, we trust you. Whatever you decide, we are behind you. We have your back. I wouldn't have done this deal if I didn't have that response because I couldn't guarantee, or I can't guarantee anything, but I wouldn't have felt comfortable promising Danny and his team that we're going to perform the way we are unless I knew these people were behind us. Because if they're not behind us, we got nothing.
On the subject of supporting customers, we have a number of listener questions that have been waiting. Is this an okay time to shift to those?
Sure.
So we have a question from David Miller. Will the market stay up past January?
And Andrew, jump in. You're a freight guy.
Yeah.
I mean,
Yeah.
I'd love to hear your opinion on some of this stuff.
Yeah,
I don't believe anybody has a true crystal ball. I don't know the answer. I stopped trying to predict what was going to happen in the freight markets a year and a half ago. I don't see it slowing down that quickly. It just doesn't make sense that everything would catch up by then. The supply's not there. The demand could drop off, I suppose, but I'm not the guy to answer that. I got a great guy in Ryan Dent who understands markets better than anybody else. I'm a big believer in sticking to what you're good at, and I've realized I'm not that good at predicting the freight markets, but I got people who are, and I'll let them answer that. So, Ken, this is your world. You go ahead.
I'll start, but then Dean jump in. I think really you touched on it, supply. It really depends. Was it PACCAR that announced yesterday they fell 7,000 units short of their own rather pessimistic internal projections on what they were able to deliver in Q3? I think as long as we continue to see those diminished Class 8 truck orders, it's going to be dicey on the capacity side. And the longer this persists, the more of a backlog of replacement units, the longer that backlog is going to get. So I think Q1, Q2, you will probably start to see things ease a bit, but it's not going to drop like a rock, would be my prediction. Now, the one wild card happens to be inflation. As inflation starts to permeate in all facets of the economy, we've talked on the show about the cost of living adjustments through Social Security as being a bellwether. I think the Q1, Q2, we'll start to see how some of those maybe $3.25, $3.50, $4 a gallon for unleaded gasoline prices east of the Mississippi start to impact. Like those are the things we'll start to look at to see if the economy is going to slow down. What do you think, Dean?
Yeah, I think I'd agree. I think I'll quote Professor Chris Kaplis in the latest DAT IQ signal report, where he said that he thinks the truckload market's going to remain elevated through 2021. Market corrections should occur sometime Q1 to Q2. But I think the most important point he made, and this is sort of where I land, is that there will be a correction next year, but it will most likely be a return to just normal inflationary growth rates, not a freight recession like we saw in 2019.
Hopefully.
That makes sense.
Tyler Gilpin asks, with reefer peak season here / coming soon, do you see any upward potential on volumes? It seems to me that we've maxed out the workforce capable of producing much more than current.
Well, I mean, you got to assume some increased volumes. I mean, just look at all the potatoes that'll be shipping in the next month or two. I mean, there's a lot of just the typical peak. I mean, I wouldn't be trying to get freight out of the Pacific Northwest anytime soon. I'll say that if you're
No. Or Southern California.
Be ready to pay big bucks.
Right.
Yeah.
There was a question in here, Ned. I lost it. It'd be a good one for Andrew about Molo's brokerage kind of structure. Someone had asked, where is it? They had asked if Molo had any assets, right? Are they a full non-asset? Are they asset light?
Yeah. So
Go ahead.
You got the classic answer you give to a shipper when they ask, "Do you have any assets?" And you're like, "My greatest assets are my people," which is true. But in terms of equipment assets, no, we don't have any. Now we do, though. I mean, that's a huge piece of this. You know, for an enterprise company, which is a lot of what we're doing is this enterprise shipper stuff. We only get a small piece of their overall pie because we're not good at drop trailer today. Brokers struggle with that. Some are getting better at it. ArcBest is good at it. They've got this business out in Reno that is doing power only drop trailers. So they've got their own equipment they're using, and then they lease on or hire on owner operators to do power only for them. We will be trying to hammer that. I mean, that's a big opportunity for us between these two companies, is being able to leverage the ArcBest assets to give our shippers what they need. I mean, everybody's talking about the increased dwell times, and shippers want the drop equipment. I mean, it just makes their lives easier. We have not done a great job of supporting them yet, but we will.
Cool. There was a question going back, Ned. You might not have visibility to it, but it was shared ahead. It was about the oil spill. Let me just read it real quick.
Please. No.
Well, the current oil spill off the coast of Orange County affects ships in the area. Newport Harbor, which is just on the coast from LA Long Beach, has closed boat traffic coming in and out due to the spill. There's obviously a lot of boats. Dean, this one's all yours.
Yeah, I mean, we kind of covered a little bit earlier. There's definitely going to be a delay. The fact that the vessels coming in are sitting around that 65 mark. I looked on the LA Port of Los Angeles signal report this week. They're expecting about 25% higher volumes week over week, next week and the week after. So in terms of what's on the water but not in that 20-mile arrival zone, there's a lot more containers coming in the next 2 to 3 weeks. So I expect that's going to cause more congestion. There's going to be more delays. We've already seen that wait time out to 10.1 days. I expect that'll grow. And that'll translate to what we've already seen last week, which is more load post volumes in the spot market as shippers try to move that freight as fast as they can to get it into markets ready for retail season. And National Retail Federation's already reporting we're going to spend more at this Halloween than we've ever spent before, according to the latest surveys. So lots of demand on that front for e-commerce freight coming out of the West Coast.
I have a question about the mechanics, Dean, and that is, I know that there's a lot of rules around oceanic freight. Is there an ability for a vessel that is stuck at anchor for a long time to divert to another port in the same country? And what kind of are the mechanics of doing that?
Yeah, I actually don't know the answer to that, Ned. That's a question I'm going to have to take notice.
Oh, that would be a customs nightmare. A lot of this stuff is electronically clearing through the port of entry well in advance of the freight getting here, and that would be, I have to imagine, an absolute nightmare. Yeah. It's bad enough to switch dock positions when you're coming in. That's what's causing a lot of this problem, right? Is this out of sequence vessels and the ports having to jumble around because like a lot of that equipment is rented, or you're renting that I mean, a lot of these ocean, they're not. There's only a few that are big enough to have the dedicated anchor or the dedicated
berth.
What's it called? Berthing space. Yeah. So, yeah, it's going to be interesting to see. From what I'm hearing right now, the director of the Port of Los Angeles has said boats can come in, no problem, but they need to be cleaned before they leave, which could be a 2 to 3 delay exiting the port. They're not going to go back out covered in oil.
Yeah.
So,
I mean that's the reason why I ask is, if we're adding a 2 to 3 day delay to this many vessels at anchor, I mean, I don't know at what point we've already seen some of the traffic get rerouted to Savannah, and that's farther out, but to what extent can you shift? And the answer seems to be not very much. Yeah,
I'd love for someone to write in to let us know.
Yeah.
Any more listener questions, Ned?
We have one more. Can we get that before we do closing?
Yeah, because I had a couple more for Andrew since we have a couple minutes if he's willing.
Please. Yeah. George Gamboa asks, any advice to new drivers starting with partial loads?
I wanted to, I mean, that's a good question for you, Andrew, if you don't mind chiming in. Are you seeing a lot? We talked to Tim Gagnon at Robinson yesterday, and they're seeing a ton, or last week, and they're seeing a ton of activity around partials right now. Are you guys seeing any of that at Molo?
Yeah, a little bit, not a ton. I'm not super well versed in partials, other than that some people are trying to rename it shared truckload and claiming it's a new service.
What do they call it? Less than truckload. That might be a novel idea.
Yes. No.
You should talk to Ark Best about that.
Yeah, exactly. I mean, partials are a great opportunity for drivers to make a bunch of money. They just got to be smart about having the right resources to pool them together, right? I mean, you just got to be able to connect enough shippers to get 2, 3 volume sized loads, 6, 7, 8 pallets. That doesn't necessarily work great with LTL, but shippers are willing to pay to move it, and you get 2, 3 of those, and all of a sudden you're getting 2 times the average line haul rate on a load. I don't have great advice for George on how to go make that happen. I would probably try to partner with some of the brokers who do a lot of that stuff. I mean, yeah, I joked about the shared truckload, but maybe they should call Flock Freight because that's what they're focusing on, and seeing if they can help them. There are a lot of great people that work over there, friends of mine. I just like to.
Yeah, Pickett's there now.
Yeah, he's great.
Yeah, he's awesome. I think the one thing to consider, a lot of people when they talk about partial, they might not mean commingling, because you got to watch, right? I mean, let's just say that you have 2 shipments and you're signing up for declared value of $250,000 each. You have $500,000 of declared value back there, liability, right? I mean, you got to be careful with that if you're a small carrier. But sure, let's just say that it is a partial. It might be 10 skids, 25,000 pounds. The rate you might be seeing on that, especially in a backhaul lane, might be very equivalent to the rates you were seeing in late 19, right? So you might be able to haul partial at break-even prices on your backhaul, which could mitigate moving empty, which could be a great strategy to help you kind of keep your utilization up and your wheels turning. But again, Dean preaches this all the time. It's all about knowing your cost, all the way down to like your fuel, your empty, your load and unload times. We had Todd Amon on too, talking about cost. So as long as you understand your costs, your risk exposure, it's something that can clearly be impactful to your network right now. Anything to add, Dean?
No, I think there's never been a more important time to watch operating costs than there is now, because we're starting to assume, especially on the asset side, a lot more higher operating costs, especially around driver wages and fuel. That's going to be baked into some of the costs we're going to see next year.
Right. All right, cool. So we're going to do one more scan for questions, but I wanted to pick your brain a little bit more, Andrew. So you guys were named one of the carriers of the year. Was it Anheuser-Busch last year, or am I?
Yeah, Anheuser-Busch named us their carrier of the year for 2021. Yeah, what year is it? Jesus.
It's 21, believe it or not.
It was. AD named us their carrier of the year, which was a very cool thing, because it's not even broker of the year. That's carrier of the year for their 300, carriers and brokers. And, I love this story for us, because I think it's more foreshadowing of what our future looks like. We were really good at this. And Anheuser-Busch, they were one of the first who gave us a chance, right? And it just takes time. I mean, you can't become a carrier of the year in the first year working with someone as a new broker. I mean, it only took us 3 years, which I think is pretty incredible. And I just think there are other shippers that were on that path. We just haven't had enough time with them yet. But again, when you are as focused as we are on the service and execution, this stuff is expected. I mean, my people understand that that's the expectation. If a shipper has some type of award program, it's a pretty clear expectation that we should be hitting it, that we should be at the top of the food chain in terms of the service we're providing them. I obsess over the scorecards that customers have, because it just, to me, that's how you win, right? You service the customer well, and over time you grow, and you grow profitably with them.
So that's your advice for moving up the routing guide is deliver the service rather than compete on price?
Yeah, to me, it's the simplest advice ever. I don't know why more people don't take it.
Do you feel like, so if you had to scan all of the enterprise customers that you have relationships with, and you looked at like your weighted average position on their routing guide, do you believe, it sounds like you do, but it sounds like you believe that the ArcBest strategic partnership will help move you up that position kind of across the board?
Absolutely. I mean, it allows us to get stickier, deeper with these customers in terms of the service offerings. Another important point to think about, it's hard to be very profitable and have as much contract freight as we do. Our balance of spot and contract is maybe the most important piece of data we need to be looking at all the time and understanding. We've had a hard time getting lower than about 60% contract, just because, again, these customers want to keep growing with us. So year over year, we see that contract number double with a lot of our customers as we service them. It's hard to balance that with the spot, because our contract tends to run in the mid single digits at best a lot of the time in the wrong markets. Well, I guess I should say in the last 2 years, which is half of our life cycle. But we've run at about mid single digits on this contract business on our margin percent, whereas on spot, we're much healthier, 13, 14%.
Is that PT or contribution margin?
Say that again?
Is that purchase tran percent you're talking about, like your gross margin, or like your contribution?
That's gross margin. That's gross.
Okay,
margin.
gross.
Right? Our water line for profitability is about 9.5 to 10% right now. And a lot of that too, you got to understand, we hired 300 people in the last year, and most of the time when you hire a broker, it takes them about 6 months before they add any actual value. You're just paying for them to be there. We've hired for growth every year, and we'll continue to do that. But my point in saying this is we do about 1,100 loads a day today as a brokerage. ArcBest has their own brokerage that does, I don't know what the number is per day, but it's a little bit less than ours. They're heavier, small, mid-size. They're 80 to 90% spot, 10 to 20% contract. You mash these two together, and boom, our balance is a lot more in favor of a healthy, profitable brokerage. We were going to get there without them, but they made it a lot easier for us. And they will make it a lot easier for us. I mean, there's a thing that I would like to be able to do. I've always wanted to be able to do it. I want our brokerage to be one that never has to give back contractual commitments or raise rates out of cycle. We have not been able to successfully do that yet. I assure you, we've raised our rates out of cycle. I can count on one hand the number of times we've done it, which makes it a lot less than a lot of our competitors have. We've stuck by a lot of our customers longer, but to make that work, to make that a success long-term, you have to have the right balance. We can't be more than 50% contract, especially in the markets we've been in the last 2 years, if we want to be profitable and not have to give back freight or change our rates and whatnot. But I think we know how to do it, and it just takes using this sales force ArcBest has, their existing customer base, and managing our commitments effectively.
I have a quick question.
Go ahead.
Go ahead.
No, go ahead.
There was something that you mentioned back at the very early part where you're talking about payment terms in terms of like days to pay. Do you feel like that's one of the as a shipper, that is one of the most effective ways to improve relationships with your brokers is improving the payment terms rather than the absolute amount.
It would be smart if they did, but like the number of times I've heard people say they want to be a shipper of choice and then they're paying me in 120 days. I mean, you're not a shipper of choice if you're paying me in 120 days. Listen, I love my shippers, even if they pay me in 120 days, but like it's hard for you, just the money matters. I mean,
it's real cost.
Paid 120 days versus 30 days is a massive difference.
Yeah.
And you just can't say you want to be one of the top shippers competing with other shippers who pay in 90 less days than you. And I understand they got to make the decisions they make. They have the leverage they do. We play within the rules. I look at the world of the freight world so simply. It's the shipper's job to make the rules of the game. It's my job to agree to the rules and play within the rules. I think a lot of our competitors don't play within the rules, and I think that's why you see freight given back and loads not delivered on time. But for us, if you say hit 90% acceptance and 93% on time, we're going to do everything in our power to hit and exceed those numbers. If you say 80%, I'll price it off that. You say 50%, I'll price it off that. That's how our team thinks about this stuff.
That's great. I mean, I'll end on this question for you because it's a simple one. What's the longest payment term request you've come across in your last 4 years at Molo?
120. We're 120 with a couple, and it's not fun.
Yeah, right before I was leaving, we were seeing a massive push with some big enterprises at 180, and I thought that's 6 months.
I'm glad I haven't stumbled on any of those yet. I have a hard time saying no to freight. It's like I want the freight regardless, and I just say, hey, we got to figure out how to manage it behind us. So, like, if I met at 180 that I really want to haul the freight for, I mean, we'd probably say yes.
Right. All right. Well, thanks, Andrew. I really appreciate it.
Great.
I highly recommend if you want to hear more from Andrew himself about why this acquisition makes sense and this partnership, I recommend checking out his LinkedIn page. He has a nice essay posted there and a couple follow-up posts, I think, which really drive the point home about culture and what his team should expect. Anything final to say, Andrew, before we wrap up?
No, I just appreciate you having me on. I appreciate getting to tell our story a little bit, and I'm excited. I mean, we've got a lot of work to do, and we're excited to do it.
Yeah, we might have to get your market guy you mentioned on here sometime. That's what the show's most normally about. So
yeah. Absolutely. Ryan Dent. I'll connect you.
For sure. All right, guys. Well, a couple things to wrap. I appreciate you sticking with us this week. I think next week we're going to go kind of long on the analytics and market stuff. There's a lot going on. I wanted to give a shout out to our customer service folks. This is National Customer Service. I forget the exact name, but it's National Customer Service Appreciation Week, something like that. These are the folks that keep the lights on. I'm sure Andrew would echo that, right? The people picking up the phones at all hours, doing call checks, or drivers can't find the dock, or the shipper wants to know where their freight is. These are the folks keeping things moving. So huge salute to them, and I'm excited to see some of the cool stuff that different companies are doing this week in support of that. Am I missing anything? The TIA show is coming up in a few weeks down in Texas. I know we'll have a presence there. Dean, you want to give a shout out to some of the stuff you're working on?
Yeah, landline now at 7 p.m. Eastern Wednesday nights. I'll be on there again this week.
And then any of the other XM stuff, Willis or Nemo?
Yes, Sirius XM next week, Radio Nemo at 8 a.m. Eastern next Thursday.
Yeah, if you haven't checked that out with Dean, I'd highly recommend giving that a listen. Really great conversation if you're kind of interested in the nuts and bolts of freight and how all that works. So with that, I will wrap us up this week. Again, a huge thanks to Andrew and Molo for coming in. I learned a lot. This was a really great conversation. I appreciate you being so forthcoming and willing to share. We'll be back next week at 10 Eastern on Tuesday, and we hope you have a great rest of your week. Bye, everyone.
Thanks.
Thank you.
Bye.